Hype has been pumping hard today, currently up about 17% after dropping a bit from 28 bucks just a couple of hours ago. This is a project with strong legs underneath it. As we could see last year, it was one of the strongest performers of 2025, and the fundamentals have only gotten stronger. For most people in crypto, trading still means the same few names. Binance, Bybit, Coinbase, maybe OKX if you're a bit more advanced. Centralized exchanges run the game. They custody your funds. They decide who gets listed. They decide what gets frozen, what gets restricted, and who gets kicked out when regulators start breathing down their neck. Decentralized exchanges were supposed to fix that, but for years they didn't. They were slow, expensive, and laggy. You'd click buy, wait 5 seconds, get front run, and pay $10 in gas for the privilege. So most serious traders stayed centralized until HyperLiquid showed up and quietly started eating their lunch. Today, HyperLiquid is processing billions in daily volume running fully on-chain, with order books, leverage, and execution speed that feels like a professional trading platform. No custody, no account freezes, no middleman. Just you, your wallet, and the market. And that's why people are paying attention. For those who don't know or need a refresher, HyperLiquid is a decentralized perpetual futures exchange. Perpetuals are leveraged contracts that let you go long or short without expiration. They're the backbone of crypto trading. On most big exchanges, perp volume is far larger than spot trading. HyperLiquid lets you trade these perps directly from your wallet. No sign-up, no KYC, no deposit into some company's hot wallet. You connect, trade, and settle on-chain. But the key thing is how they do it. HyperLiquid isn't running on Ethereum. It's not a layer 2. It's not using rollups. They built their own high-performance blockchain from scratch, purpose-built for trading. This chain is optimized for low latency, fast finality, and massive throughput. Blocks finalize in under a second. Orders execute almost instantly. That's why trading on HyperLiquid feels like a centralized exchange, just without the centralized risks. For years, crypto traders accepted a bad trade-off. If you wanted speed and liquidity, you used centralized exchanges. If you wanted self-custody, you used clunky DEXs and suffered. HyperLiquid breaks that trade-off. You get fast execution, deep liquidity, tight spreads, on-chain settlement, and self-custody at the same time. That combination is rare. It's why serious traders are migrating, not just retail, not just DeFi natives. Whales, funds, and high-frequency players are moving in. People who care about slippage and latency. When those players move, volume follows. And volume is everything in trading. Speaking of trading, head over to the description and check out OKX for a hefty €100 bonus, up to 200 for referring friends, and more. They are consistently one of the highest-ranking exchanges worldwide with great liquidity, huge amount of pairs, excellent security. The list goes on. Sign up for these bonuses and let's continue. Behind the scenes, HyperLiquid runs a fully on-chain order book. Most decentralized exchanges use automated market makers, pools of liquidity, formulas, curve math. HyperLiquid doesn't. It matches buyers and sellers directly like Binance and Bybit. But the matching engine lives on their own chain. Validators process orders, update positions, calculate funding rates, and finalize trades in real time. There's no hidden off-chain matching, no black box. Everything settles on-chain. You can verify it. That transparency matters. No hidden liquidations, no secret priority flows, no exchange quietly trading against you. What you see is what happens. One reason HyperLiquid exploded is simple. It feels good to use. The interface is clean. The charts are fast. The order book updates instantly. You don't feel like you're on a Web3 product. You feel like you're on a professional trading terminal. Funding rates update in real time. Margin is clear. Liquidation prices are visible. Position management is intuitive. For people who've spent years on centralized platforms, the learning curve is basically zero. Connect wallet, deposit USDC, trade. That's it. No MetaMask gymnastics. No bridging nightmares. For a long time, HyperLiquid had no token, which was unusual. Most DeFi projects launch a token early, use it for incentives, and dilute users for years. HyperLiquid focused on product first. Then came the airdrop. Active traders received hype tokens based on usage, volume, and engagement. Some users made life-changing money. Others missed it and are still salty. Hype is used for governance, staking, and securing the network. Validators stake it. Users can delegate it. Protocol fees flow through it. This ties platform success directly to token value, not perfectly, not magically, but structurally. Now let's talk about price targets and entries, because this is where most people either make their money or give it back. First, big picture. Hyperliquid's token, HYPE, is still tied almost entirely to platform usage. This isn't a meme coin. It doesn't pump just because someone tweets about it. If volume grows, fees grow, staking demand grows, and that tends to support price over time. So any target starts with one question. Does Hyperliquid keep taking market share? If it does, optimistic scenarios open up. In a strong bull market where crypto liquidity is flowing and perpetual trading is booming, it's realistic to imagine Hype reaching valuations similar to mid to large centralized exchange tokens in past cycles. That would imply a multi-billion-dollar market cap. Depending on supply at the time, that could mean several times higher than current levels. Not overnight, not in a straight line, but over a full cycle. More aggressive scenarios assume Hyperliquid becomes the default on-chain trading venue. If it seriously challenges the top centralized exchanges in volume, then double-digit billions in valuation is not impossible. That's the high-end outcome. Low probability, high reward. Now, how do you approach entries without gambling? First rule, don't chase green candles. If hype is up 30% in a week, buying there is usually emotional, not strategic. Historically, even strong tokens retrace. They breathe. They reset. Better entries tend to happen after hype cools off. Periods of low volume, sideways consolidation, pullbacks to major support zones. Moments when nobody is talking about it. That's where risk-reward improves. A practical approach is scaling in. Instead of trying to nail the exact bottom, you divide your position into parts. Buy some on dips. Buy more if it drops further. Hold some capital in reserve. That reduces the chance of blowing your entry. For profit-taking, the same logic applies. Don't wait for the top. Nobody times that consistently. Scale out into strength. Trim when price looks stretched. Rebalance when everyone is euphoric. If hype does go into a parabolic phase, that's when discipline matters most. Now, let's talk about things to watch out for. First, volume trends. If platform volume starts declining for months, that's a warning sign. This is a utility-driven token. If usage drops, fundamentals weaken. Second, incentive changes. Watch how rewards, fees, and staking evolve. If token emissions increase too aggressively, that can create sell pressure. If incentives get cut too sharply, user growth may slow. Third, technical stability. Any major outage, exploit, or prolonged downtime hurts credibility. For a trading platform, reliability is everything. One serious failure can change sentiment fast. Fourth, regulatory signals. You don't need to panic over every headline, but if major jurisdictions start openly targeting non-KYC perp platforms, that risk deserves attention. And finally, competition. If another platform starts matching Hyperliquid's speed, liquidity, and user experience, market share could fragment. Dominance is never permanent in crypto. So the realistic mindset is this. Hype has strong upside if the platform keeps winning. It also has real risks if momentum stalls. Treat it as a high-conviction growth play, not a guaranteed lottery ticket. Manage position size, respect volatility. Let the fundamentals guide you, not the timeline in your head. That's how you stay in the game long enough to benefit if and when the optimistic scenario finally plays out. What do you think? Is hype going to be among 2026's top contenders like it was last year? Don't forget to check that link below. Drop a like if this was helpful, and I'll see you in the next one.